Ever wondered if you could outsmart the market by timing your investments perfectly? This thought, my friends, is the very essence of market timing. It's a tantalizing concept, isn't it? The idea of buying low, selling high, and making a hefty profit in the process. Market timing is akin to a siren song, luring investors with the promise of huge returns. It's based on the notion that if you can accurately predict the peaks and troughs of the market, you can maximize your gains and minimize your losses. It's the dream of every investor, the vision of buying at the bottom of the market, selling at the top, and watching the profits roll in. But here's the million-dollar question. Is market timing really the golden ticket to investment success? Or is it just an illusion, a mirage in the financial desert? Let's delve into a real-life story to uncover the truth about market timing. Meet John, an investor who thought he could beat the market with perfect timing. John, like many others, was seduced by the idea of predicting the market's highs and lows. He was convinced that he could buy low, sell high, and make a fortune. The allure of this strategy was so strong that he overlooked the inherent risks and potential pitfalls. John began his journey with a sense of optimism and a large amount of capital. He would spend hours each day studying market trends, convinced that he could spot patterns and predict future movements. He bought stocks when he believed they were about to rise and sold them when he thought they were about to fall. His strategy seemed to be working at first. The stocks he bought would rise, and he would sell them for a profit. But then, the market took a turn. Stocks that John had bought at what he thought were low prices dropped even lower. Fear of missing out had driven him to buy high, and now panic set in. He sold his stocks at a loss, hoping to cut his losses short. But the market recovered, and the stocks he sold went on to reach new highs. As John's losses mounted, so did his stress. He was constantly watching the market, unable to sleep or focus on anything else. He was obsessed with trying to recoup his losses, but the more he tried, the more he lost. His health suffered, his relationships strained, and his financial situation became dire. Despite his best efforts, John's attempts to time the market had failed. He had fallen into the trap of buying high, out of fear of missing out, selling low due to panic, and had wasted countless hours watching the market. His story serves as a cautionary tale to others who may be tempted to try their hand at market timing. John's story is a stark reminder that market timing is not as easy or profitable as it seems. John's experience is not unique. In fact, the pitfalls he faced are common among those who attempt market timing. Let's delve into why this strategy is often a waste of time. Firstly, the market is unpredictable. Trying to predict its movement is like trying to predict the weather in a month's time. You're more likely to be wrong than right. Secondly, the risk of missing the best days in the market is high. Even missing a few of the best days can significantly reduce your returns. Furthermore, market timing comes with high transaction costs. Each buy and sell order you place incurs a cost, and these can add up if you're frequently trading, not to mention the stress and time consumption that comes with constantly monitoring the market. Research also indicates that a long-term buy and hold strategy typically outperforms market timing. So it's not just about the potential losses, but also the gains you could miss out on. As you can see, the risks and costs of market timing far outweigh the potential benefits. So if market timing isn't the answer, what is? Well, it's a strategy that's as old as investing itself. It's a long-term buy and hold approach. This strategy values patience, discipline, and consistent investing over time. Think of it this way: the market is like an ocean, always in motion. Attempting to predict its next surge or retreat is like trying to catch a wave with a teacup. You might get lucky once or twice, but over time, you're more likely to get soaked. Instead, consider yourself a ship. A ship doesn't alter its course with every wave. It sets a destination and adjusts its sails along the way. Similarly, a wise investor doesn't react to every market fluctuation. They set financial goals and stick to their investment plan, riding out the market's ups and downs with patience and discipline. That's the essence of the buy and hold strategy. Remember, the most successful investors are not those who time the market, but those who spend time in the market.